Hi, my name is Ryan Smillie, and I'm an Associate Portfolio Manager here at Luft Financial and IA Private Wealth. And today's video is going to discuss rational portfolio expectations, and we're going to base those rational expectations off of historical returns and take a closer look at the range of returns for the S&P 500 and the US fixed income market, and also look at the volatility, so year to year what we can expect, not just the averages. Secondly, we're going to discuss why a balanced portfolio is a suitable solution for many investors. And thirdly, we're going to discuss the current investment environment and what rational expectations are as we move forward. Let's start off by looking at the historical market returns and volatility of the S&P 500. So the chart you're looking at right now shows the annual returns of the S&P 500 from 1980 to 2023. What you'll notice is that 33 out of 44 years are positive for returns. That means if you were invested fully in the S&P 500, you would have had a positive annual statement 3 out of every 4 years, meaning you're going to have a negative statement 1 out of every 4 years. The red numbers show how much the S&P 500 dropped each year from a mid-year sell-off. You can see that 100% of calendar years there are sell-offs or drops, with the average mid-year sell-off being 14.2% to the downside. Even with the average mid-year drop-off being 14.2%, the average annual return over that same time period was 10.3%. That means every positive year has had a negative period of returns. The most extreme example of this is 2020 and COVID. The S&P 500 dropped 34% early in the year, but finished up 16% by the end of that same calendar year. Let's take a closer look at the S&P 500 returns on a monthly basis, because I know many of you check your statements monthly and want immediate results. Over the last 30 years, historically 37% of the time an investor in America's top 500 companies has opened their monthly statements, those statements have been negative. But 63% of months have been positive. So that means don't get caught up on what your monthly statement says. You're in it for the long term. You shouldn't be invested in equities if your time frame is 1 month anyways. Just let the stocks do the hard work and your account will grow over time. Now moving on to fixed income. So if we take a closer look at bonds or fixed income, what you'll notice is that 43 out of 48 years are positive in this chart. That means that 89% of the time, if you are strictly invested in fixed income, your annual return would be positive by year's end. But the red numbers show how much the aggregate bond index dropped each year from a mid-year sell-off. So just like equities, bonds sell off too. You can see that 100% of calendar years, there were also sell-offs and drops, with the average mid-year sell-off being 3.5%, so much lower than equities. Although many of us remember the historic sell-off in fixed income in 2022 of 17%. This was caused in large part by a historically rapid rate of interest rate hikes by central banks. Let's look at the range of returns over 1 year and 5 year periods. So if you've come in for a meeting with our office, you've heard us the whole spiel about if you need money within 3 years, your only option is cash. Why do we say this? If we look at the range of returns on equities, and we'll concentrate on equities and on balanced portfolios. So a 100% equity investor has experienced a range of returns that goes from positive 83 to 87% over a 1 year span, but they've also experienced downside or negative returns of between 39 and 51%, depending on how much they have invested in Canada versus how much they have invested in the US market. So versus a balanced investor experiencing roughly half the downside and roughly 63% of the upside of those equity markets. If we span this out to 5 years, the range of returns tightens on all asset classes, but specifically if we look at balanced portfolios, So on any 5-year period dating back to 1935, a balanced investor has experienced a positive return. Let me say that again. Over any 5-year period dating back to 1935, a balanced investor has experienced a positive rate of return with a return range of 0.9% to 27% annualized over that 5-year period. Whereas an equity investor has been positive the majority of the time, there has been instances where that 100% equity investor, whether it's 100% of their investments are in the US market or 100% are in Canadian, they have returned negative on occasion. So now where does all this historic information leave us now? So let's take a look at the current investment environment as of June 2024. So we're going to start off looking at the monthly S&P 500 return chart. So if we look at things rationally, nothing's changed. There's no reason to believe that there's going to be any less or more volatility on a monthly basis going forward as there has been over the past few decades here. So we have roughly a 63% probability of having a positive monthly statement and a 37% probability of having a negative monthly statement if we were invested purely in the S&P 500. We have a rational expectation that our balanced portfolio will have a positive return over the next 5-year cycle. If we oversimplify our long-term portfolio expectations over the next 10 plus years and assume interest rates will stay flat, where are returns going to come from? Assuming historical averages above, and we look at a 60% equity, 40% fixed income mix, the 60% of our equities, assuming they get 8% rate of return, are going to attribute 4.8% of our portfolio's overall return. 40% fixed income, assuming a 5% rate of return, that's going to attribute 2% of portfolio return attribution. So what do we get? Total annualized average return estimate would be 6.8% based on current interest rates and historical averages for equity returns. Now, just to give you an idea, our current fixed income portfolio, our flagship fixed income fund currently has a yield to maturity of 5.6%, so it's just over that 5% return estimate for fixed income if fixed income rates stay flat. The purpose of today's video is for you to take a step back from your monthly statements. Don't focus on the monthly highs, don't focus on the monthly lows. Enjoy the journey and you'll get to your destination. Thank you for watching, and if you have any questions, please feel free to reach out to any one of the team members here at Luft Financial and we'll be happy to help.